This video on the channel, Blocks Bonds Funds, is created for educational and informational purposes only and does not constitute financial or investment advice.
Hello and welcome. Today we are asking a really fundamental question in the world of crypto. When you're buying, selling, or just holding your digital assets, who is really in control? Is it you or someone else? We're about to dive deep into the massive differences between centralized and decentralized systems. All right, let's get right into it.
And that really brings us to the core of the whole issue, doesn't it? I mean, when you use one of those popular, super user-friendly crypto exchanges, do you truly own the assets that are sitting in your account? Well, the answer might actually surprise you, and it all comes down to one absolutely critical concept: custody. So to really get the trade-offs here, we've got to start with why centralized exchanges, what we call CXs, are basically the front door for most people getting into crypto, They're built on this promise of making a very complex world feel simple, feel accessible. And what's so interesting here is how much this all looks like traditional finance. CEXs give you these really quick signups, an interface that feels just like your normal banking or brokerage app, and maybe most importantly, that easy on-ramp to turn your dollars or euros into crypto. On top of all that, they have high liquidity, which just means your trades happen really fast without the price jumping all over the place. It's all designed to be a convenient, streamlined experience. But, and this is a big but, that convenience definitely comes at a price. See, behind that slick interface and those lightning-fast trades, there's a huge structural risk that, honestly, most people just don't see until it's way too late. The very thing that makes a CX so easy to use is also what makes it incredibly vulnerable. So here's the bottom line. When you put your crypto onto a centralized exchange, you are handing over control. You're giving them custody. The exchange holds the private keys to your assets, not you. And what that really means is you are trusting a third party to keep your funds safe, which creates what we call a single point of failure. You've probably heard this phrase before. It has become the ultimate mantra in the crypto world, and for good reason. It represents a huge shift in thinking. If you don't control the private keys, you don't really own your crypto. What you own is an IOU from the exchange. You're just operating on trust, hoping that they'll honor that IOU whenever you decide you want to withdraw. And this isn't just some theoretical risk. I mean, look at this. History is absolutely littered with these catastrophic failures where that trust was completely shattered. From the infamous Mt. Gox hack that almost destroyed Bitcoin's reputation to the truly bizarre Quadriga CX case, where the founder's death just sealed off access to $250 million. And of course, the massive collapse of FTX, where customer funds weren't just lost, they were fundamentally misused. These events show you the devastating consequences when that trust gets broken.
You want to put a number on it? Okay. Since 2012, we're talking about almost $3.5 billion stolen. And that's just from hacks alone. That staggering number doesn't even begin to cover the billions more lost to pure mismanagement, companies going broke, or just outright fraud. It's a pretty stark reminder that when you pile up that much money in one place, you're basically creating a honeypot for attackers.
So, as you can imagine, in response to all these failures, a completely different model started to emerge, one that really goes back to the core ideas of blockchain itself. This is the world of decentralized exchanges, or DEXs, a system built not on trusting people, but on verifiable code. So what in the world is a DEX? Well, think of it like a marketplace that just runs itself on code. It's a peer-to-peer system where trades happen directly between you and another person, all guided by these self-executing programs we call smart contracts. And here's the crucial difference. No company, no central entity, ever takes custody of your funds. This table just lays out the differences perfectly. With a CX, the exchange has your funds. With a DEX, you do. Simple as that. With a CX, you're trusting a company and the people who run it. With a DEX, you're trusting that the code, which is often public for anyone to see, will do exactly what it says it's going to do. And of course, while CXs need you to prove your identity, most DEXs let anyone with a wallet participate. Okay, but wait a minute. If there's no central company playing matchmaker between buyers and sellers, how do trades even happen? This was a huge puzzle for early DEXs, but it was solved by this brilliant innovation called the Automated Market Maker, or AMM for short. Okay, let's break this down because this is where the real magic is. A CX uses a traditional order book, kind of like a stock exchange, right? It's always trying to match a specific buy order with a specific sell order. And AMM just throws that whole idea out the window. Instead, it uses these giant pools of tokens that are supplied by other users, and then it uses a math formula to figure out the price for any trade, instantly. It is a fascinating and elegant solution. So how does this actually work in practice? Well, first, you have users that we call liquidity providers, and they deposit pairs of tokens into a big shared pool. A smart contract then locks those assets and manages the pool. Now, when a trader comes along, they swap their tokens directly with the pool, not with another person. The price? That's set automatically by an algorithm based on how that trade changes the ratio of the tokens in the pool. And for providing the assets in the first place, those liquidity providers get to earn a small cut of all the trading fees. Now, this all sounds pretty amazing, right? But like with everything in life, there are trade-offs. The decentralized model, yeah, it solves that huge custody problem, but it also brings its own set of challenges to the table that we really need to be honest about. For starters, just getting started can be a major hurdle. Unlike a CEX, you have to set up your own digital wallet, you have to manage your own keys, you're responsible for your own security, and that's a big leap for a beginner. On top of that, every single thing you do on the blockchain has a fee. We usually call it gas, and these fees can be wild. Sometimes they're super high, making small trades totally impractical. So it's a very clear trade-off. You get way more control, but you also take on a lot more responsibility and potential cost. And there's another pretty big storm cloud on the horizon: regulation. The whole anonymous, anyone can use it nature of many DEXs has definitely caught the eye of global regulators. There's this growing pressure for these platforms to start implementing know your customer and anti-money laundering rules, which for many users goes against the entire point of privacy and decentralization. And so we kind of end up right back where we started. The entire crypto ecosystem presents us with this fundamental choice. On one side, you have the convenience, the speed, and the simplicity of centralized systems that just ask for your trust. And on the other, you have the control, the ownership, and the freedom of decentralized ones that instead ask for your technical responsibility. This tension, this battle between these two philosophies, it isn't just about crypto. It's about what we want our entire financial future to look like. And that is a question we'll leave you with today. Thanks for joining us.